Thank you, Aditya. Thank you for kind words. Thank you for introducing me. And good evening, audience. You made my life easy actually of presenting this product because before me we had Saurabh. So he took actually most of the he actually introduced to the audience most of the macro environment around fixed income and what we are seeing a shift from a open-ended fixed income investment products into closed-ended. So in that sense, that message is already conveyed. So most of it sort of is already done. So my job is in that sense relatively easier. I just have to introduce the product. But thank you. So audience, as a house, there are three things which underpins the product which I'm going to introduce today. The ICOF1, the way we call it as, or a close-ended debt AIF. Factor number one, we think the macro of investing into fixed income is improving significantly. Probably is the best vintage to invest into fixed income investments into the country right now. From a pure risk reward perspective, fixed income investing for investors in India has never been better before. So that's factor number one. Factor number two is our endeavor to bring, I would say, a portfolio management style of investing. So basically focus around portfolio construction, portfolio granularity, towards being able to earn on behalf of our investors the kind of returns on a risk-adjusted basis that we are asking the mandate for. And the factor number three is around our own capability as an institution, the track record, if you will, and our own track record as individual team members. So these are the three things which underpins the way we have designed the product, which I'm going to present now. So here I start. The first factor which I said, if you recall, is our view around macro around macro environment, how we think fixed income or credit investing in the country is panning out. Most of the slides, as I said at the top, sort of has already covered. So some of these is going to be repetition, but I think it's good to recall those because it just sets the background around which this product has been designed. So if you see, and we specifically thought about identifying these two subsegments or credit providers in the country. They are banks and they are NBFCs. The banks and the NBFCs, I would say, constitutes most of the incremental credit dispensation to this country. And look at what is happening on the market, on the bank side. As the time is progressing, banks are either shifting towards their incremental credit for the top rated borrowers of the country, or they're focused only on the retail. This missing middle is what is suffering from non-availability of credit from banking segment. Dovetail that into some of the flexible credit strategy or flexible credit needs. I would say some of the private and new age banks in the past were providing credit in that subsegment also, but even those banks have stopped lending to that segment. So the entire missing middle and let's say some of the flexible credit needs is not provided by banks, which is causing a big supply white space for this kind of credit. The demand still exists, but the supply is not there from the banking system. Similarly, if you shift your attention towards NBFC, you would see the same story. Either the wholesale NBFCs have stopped existence quite literally, or are non-existent quite literally, or you would say again they are mimicking or mirroring what large banks are doing, which is basically focusing on retail. So the two largest credit providers in this country, I would say from a private credit standpoint, as well as people or the companies which are requiring vanilla credit requirements, are not able to get that either because their vintage is lower, they're just 3, 4, 5 years in existence of their life, or their need are in that sense not strictly the need what a bank would put that as an end use, approved end use. Two small credit providers, I would say, outside of banks and NBFCs, which is the mutual funds and the bond market. The story there is secular actually. I mean, those were fringe players anyways, and with the dislocation which the Indian credit market saw in post 2018, so post 2019, has actually decimated even that small category. So in summary, what we are seeing from the traditional credit providers in the country, as well as the fringe players, no one is really catering to the demand, which we would call as let's say a flexible capital requirement, which actually makes us actually wonder why, which makes us wonder how this demand will be catered, and actually in the same vein excited about credit investing into this country. Another macro point which I want to cover is around this emerging corporates ecosystem. This emerging corporate ecosystem is now has reached to a level which cannot be ignored. Look at the number of unicorns that the country is making, 44 in 2021. By the way, this was a year when India for the first time overtook China. China actually created 42 unicorns, but India created 44. So more than China. Impressive. Look at the number of people who are now employed into this emerging corporate ecosystem or a startup world. More than 4 million people. This is probably more than the entire pharma sector put together, which has been in existence for the last 15, 20, 25 years. And India probably is one of the leader in pharma segment. Look at the amount of investments which is flowing into this segment and is growing this segment. The amount of capital churning, or let's say the exits in this segment, all of them is pointing towards the fact that this is a segment which just cannot be ignored. And by the way, this is a segment where none of the capital providers, be banks, NBFCs, mutual funds, capital markets, serve from the demand, from the supply perspective. So through these 3 slides, I just wanted to convey a message that on a macro basis, purely on the demand and supply side, and a lot of has been written. So I will not bore the audience with more details, but purely from a demand supply dynamics perspective, there is a huge, I would say, a supply white space which has to be somehow filled. And this is where our product has been designed. So what are we talking about when we are saying this is the first fixed income product that we are launching? This is nothing but, as I said at the top of the thing, we are bringing portfolio management style towards fixed income asset management, which is underpinned again on portfolio concentration, construction and portfolio concentration. We are basically bringing uncorrelated risks and creating a curated portfolio for the investors. Our target is basically to create a portfolio which is a multi-strategy portfolio of 3 subsegments. 40% emerging corporates. If you recall, this is which is the previous slide which I showed. 40% established corporates, and 20% towards financial institutions and platform. Mind you, these are the sectors, again, if you recall, purely from the supply perspective, the traditional people have vacated or never catered to. So we are creating a portfolio which is a combination of these 3 sub-strategies in a defined 40-40-20 proportion. Which we are also trying to create, let's say, a granularity into the portfolio, where we are saying that a single investment is not going to be more than 5% of the overall portfolio, which means we are going to do 20 plus transactions into this portfolio. So portfolio construction, we are very thoughtful about, and portfolio concentration, we are very thoughtful about. It's going to be a 500 crores plus 500 crore green shoe option fund. So in total, 1,000 crore fund. With a target yield of 17% gross IRR. We have kept this fund as a short fund because we do not want to take a huge interest rate risk. We see our view on the market is right now. We think right now is a market where this demand supply attractiveness exists, as a result of which these kind of yields are achievable. We do not have the same view 2 years out. Who knows, the demand supply dynamics will remain the same or will not remain the same. However, we think the opportunity is right now. Hence, we have kept this portfolio as a very short portfolio, 4 years from final close. So, and from the 17% IRR that we are targeting of the overall portfolio, we think we are targeting at the minimum 8% out of the 17% to be in the form of regular cash distributions. In addition to in addition to in addition to us individual as investment team, as well as the InCred ecosystem, we are also very thoughtful around how we are going to approach governance of this entire fund. Will it have a mix of internal people, external people? How we are going to do? How are we going to use some of the wisdom of external committee members? I'll come to that shortly in the subsequent slide. So, as I said, we are very thoughtful about portfolio construction, the 40-40-20 construction rules that we have put. So we have tried to put that in form of a slide where we talk about what is exactly the zone that we are going to actually play into, and this is what it is. The way we see corporate India landscape, we see corporate India either as early stage corporates who just started, probably between 0 to 3 years of their existence, largely being catered by venture equity, venture capital guys, and to a certain extent even venture debt for their capital needs. These kind of corporates are, from a unit economics, EBITDA and free cash flow basis, negative. Hence, the risk is more oriented towards equity because the risk that they're underwriting is more existential. As we move along into the life journey of a corporate, the venture or early stage corporates transfers or translates themselves into an emerging corporate. This is a category which we think is 4 years plus in terms of their age. They have established their unit economics. We know the existential risk doesn't exist or relatively reduced to a large extent for an investor like us to be comfortable. They might not be EBITDA positive or free cash flow positive just yet because they chose to reinvest most of the gross profit generation again back into the company and actually building that cost base right now, which is for the future, maybe not for the present, but for the future. As a result, their EBITDA negative and free cash flow negative. This is a time when some of these guys, in addition to venture debt, can also be catered through private credit as a platform. And from emerging corporates, the companies then metamorphoses into established corporates. These are the companies where the unit economics have become positive, even the EBITDA has become positive, and sometimes even free cash flow positive. So this is the play zone for the fund that we are targeting, and the 40-40-20 is going to be effectively into this. So mind you, we are not going to actually invest into companies who are not even established from their unit economics perspective. No one knows how this business model is going to really pan out and whether these companies will remain in existence after 1 year. So these companies have already established their mark. If they're into, let's say, consumer segments, then market shares has been established into their key geographies. If they're into, let's say, some of the branded play, we know that they are well and truly there in terms of challenging and established brands. So the risk of, I'm making this point again, the risk of existence for this company no longer exists. This is another point which I want to highlight, and this again underpins the way we defined our strategy. No more this portfolio is going to be curated and is going to be managed by, let's say, just us individual as investment team. It is going to be curated purely both from deal doing basis as well as on an ongoing portfolio management basis between the investment team, the InCred ecosystem, as well as some of the external advisors that we have to the fund. We have stringed along basically 3 market veterans who we think their wisdom will actually help us in terms of curating this portfolio as well as managing this portfolio so that we can deliver the 17% IRR to our investors. We have stringed these 3 individuals into credit committee, which is a gatekeeper in terms of doing new deals, and portfolio management committee, which is a gatekeeper in terms of regular updation, monitoring, any covenant tightening needs to happen or any exit event needs to be done. Who are these 3 individuals who have graciously agreed to be external advisors to the fund? Mr. P.N. Prasad, Deputy Managing Director of State Bank of India. Mr. Debashish Datta Gupta, ex-Citibank and Lehman Brothers, and Krishna Datta, who is a lawyer by background. So a credit guy, Debashish brings risk management and external market skills to the table, and Krishnava, who brings legal skills to the table. All these three things are required for any kind of fixed income investment decision making, as well as fixed income asset management. You need to know who you are lending to. You need to know how some corporate houses, borrowers, as well as some of the industries have behaved in previous cycles. You need to know if something needs to be done proactively, how should your lending documents be structured? If something needs to be done on a reactive basis, what should your enforcement strategy be? Hence a lawyer in the mix. So the point that I'm making is it's one of the most important, and we treat this as one of the most important feature of our fund, where we are stringing along the right kind of external talent who acts as an external and independent gatekeeper in terms of creating this portfolio for the investors, helping us create this portfolio for the investors, and an ongoing monitoring of this portfolio. The third thing which I said, which underpins the strategy for us, is our own track record, be it individuals or the platform. So InCred as a InCred as a platform has actually, since last 5.5 years of its existence, has on a cumulative basis lent close to 2,200 crores of credit to such kind of, let's say, corporates. These are approximately 150 unique borrowers. And I mean, we are actually very proud when we say this. In those last 5.5 years of our lending or play into this market, we just have, let's say, one accident, and that too very small. And again, if we really dissect why it happened, it's not that we made a brilliant decision, etc. It just our diligence and diligent approach towards investing, and also our granularity. We have kept very high standards for us in terms of doing per deal ticket sizes, because we think at the end of the day, what is the difference between a private equity and a private debt? The range of outcomes in private equity can be that much, right? The variability can be that much. You can have 30-40% IRR, and the way down it can be 0, right? If you see private debt, the range of outcome is narrow. You just have to play in this zone. You're making 17% or maybe 16 or maybe 15.5. You're not going to make more than 17% return, right? So hence, you should have every single decision right. Every single investment that you're doing has to hit the mark in terms of your underwriting, and all that can happen only at the portfolio level. You have to be diversified in your approach towards investing. You have to cater to various things, many things, multiple, let's say, type of businesses, vintage of the businesses, and also it has to be granular. No single deal should result into a disproportionate change into your overall economics. So that's what we have done, what we have learned, and we are going to follow that into our into the fund that we are introducing here. Some of the names that we have lent to from in our past are given here. Most of these are public names, visible names, market leading companies of their specific segments. Again, making a point that I would say most of these companies, or in fact all these companies, existential risk is no longer there. I mean, it's not as if that these companies are going to simply just vanish tomorrow. If we just extrapolate individual team like myself as well as the other team members investing experience into India, and just put that into some sort of, let's say, analytics, you would see we as a team have actually invested or lent into all the sectors, be it pharma, healthcare, autocoms, logistics, consumer, hospitality. So I would say a diversified and multi-sectoral experience. How have we really underwritten exits? The most important thing into, let's say, fixed income investing into this country, or let's say anywhere, fixed income investing generally, is what is the end state that you're projecting? Your end state is not as if the company is X, it is going to become 50X, and hence I'm going to make equity return. Your end state analysis is the company is X, it should at least remain X for it to be able to give me my coupon, my 7. Mind you, I'm just making 17% return. I'm not making 25, 30, 40 return, 40% return. So my end state assessment and monitor that path or that journey towards end state assessment has to be very, very, very strong. If you see, most of our investments have been operating cash flow driven underwritten exits. So our thesis was always been company is going to generate EBITDA, they're going to repay our debt, and we're going to go home. Quarter of our investments has been equity driven or equity event driven. From a tenor perspective, again, we think our assessment is fixed income investments on such kind of, let's say, investment strategy has to be a shorter duration. You can't take long duration risk. And that shows actually into our individual track records also, that less than 3 years, 39%, between 4 to 5 years, 59%. More than 5 years is just barely 2%. And LTV profile, again, we are very conservative around what kind of deals that we do, what kind of collateral that we take, and loan to value has been how much. So 30 to 50% LTV, 78% of the deals basically falls under that. How do we make these investments? So the style of investing, I would say, it's a cliche to use, but the style of investing is actually private equity style. Yeah, it's a pretty intimate investing style where you spend a lot of time with the company, with the founders, with the management team, just to understand what are they doing, what is their business model, how are they executing it, what is their future plan, are the manufacturing facilities really up to the standard where they can actually achieve what they have in their head, or what their plans are, which would involve a deep credit underwriting, both from the information supplied by the company as well as then diligencing on them using third-party resources, which we pull in along with the investment teams, let's say, understanding of the segment or the business. Post-credit underwriting, we also do something called a deal structuring, where now we know, okay, this is the way businesses' cash flows are expected to pan out. This is our thesis. How should we structure it? Should this be, let's say, 100% cash coupon deal? Should it have regular amortizations? Do company need some, let's say, lumpy cash flows because they would be investing into their facilities for capexes, for capacity and expansion? So all of that deal structuring are basically forms part of this entire activity called deal structuring. In the process, we will also put some covenants around, okay, if we have to lend this much amount to this company, then these are the covenants that the company needs to adhere to. For example, company should not, or covenants, or very simply put, the guardrails the company should operate their business into. Their working capital should not expand further post this point. Let's say their leverage should remain this. So covenants will basically puts an agreement between us and the borrower that for the next 3 years, 5 years of our existence into their capital structure, this is the way business needs to behave. And once we have given the money or money out of the door, then it needs to be monitored and managed on a, depending on the cadence that we have agreed with the borrower, either on a monthly or a quarterly basis. It can be a light touch monitoring mechanism where it's just simply company providing their pre-agreed MIS to us. We see this. If we have, let's say, any questions, we ask, and that's end of the story from that quarter monitoring perspective. Or it can be slightly more than that, where we actually have some of our own people, third-party individuals, actually monitoring the funds flow, cash flows, etc., on a regular basis. Some of the things that we like, we do not like. I will start with what we don't like. This is a performing credit fund. So the strategy that we are proposing here is performing credit. Hence, by definition, we do not do distress. We do not do stress. We have expanded the scope not to include, let's say, stress or distress into other group companies, because we think if the group is in stress, or the promoter or the founder at some other level is in stress, the stress tend to seep into even the good operating companies also. Hence, we do not, we basically, it's a big negative for us. Hence, liver distress, stress situations we do not like of the corporate that has come to us for borrowing or at the group level. Some of the sectors that we do not like also includes power sector, gems and jewelry, mining, trading sectors which has high government intervention. It could be government intervention, could be purely on as a customer level, or it could be as a raw material provider level. We think entities who you not have an ability to control, it's difficult to get into those businesses where those entities exercise a lot of, let's say, control. If you recall, we do not do venture, I would say, companies which are early stage 0 to 3, where even unit economics are not established. We do not want to take those risks where company buys raw material, sell it products, and in the middle not even make money. They can be not making money because their fixed cost is high, because they chose to grow more. But if your unit economics is negative, it is something which we tend to avoid. So same point again, groups which has history of default, currently everything is okay, but 3 years, 5 years, 7 years past, there was a history of default. We again think that things tend to repeat. We do not want to take those risks. And finally, something where we are very specific about our structures, about documents, and the collaterals that we are going to take. Hence, any kind of loan where there is a limited access to that, no, it's a big no for us. What we like is a complete ulta of what we don't like. Corporate governance and presence of institutional investors has to be there into the companies that we're lending to. Companies which are high growth sectors, companies which have positive unit economics, and basically the structure and the collateral has to be robust. Coming to the end part of our presentation. So this is in a nutshell what this product is really. Think about it. It's a performing fund, 500 crores plus 500 crore in form of a green shoe. InCred as a sponsor believes in this strategy, has a lot of view on this strategy, and hence we are putting a significant amount of money as a sponsor commitment. So 50 crores out of the 500 crores we're putting in. Yeah, and this is a fund structure that we have. So basically we have some of the advisors or marquee investors or marquee advisors as being part of this fund structuring. We wanted to do it. This is the first time we are doing it. We are serious about it. We wanted to do it right, and hence Trilegal is our legal advisor, ENY is our tax advisor. We also have, in addition to an ability to attract domestic investors, we also have offshore investors, basically through a feeder fund structure, who is going to be basically a potential investor in this fund. So this is where I end. Happy to take any questions if I have not already overrun the time.